So I had to come back with a part two. Understanding business taxes is probably the one thing that is costing you so much money in your business. And it is the number one reason that so many business owners at any income level are owing so much in taxes. I want you out of that predicament. Like, comment, subscribe, and check out part two of Understanding Business Taxes. So I legit got 20 minutes and I am going to spend that with you guys because I love you all. And the number of people that I talked to today overwhelmingly came from Instagram. So it's time to jump into a part two of this Understanding Business Taxes. I'm about to jump out there and just say everything that I've gotten questions about, a lot of stuff that you've probably got some type of misconception of, and I'm about to reassure you on the little to no income that you have coming in that business, what that means for your taxes. So we gonna hit it, we gonna quit it, we gonna get out of here. But I wanted to make sure that as long as you are following me, as long as you are joining me, you have the basic understanding of business taxes. Just go ahead and drop a comment if you're with me. Let's get started. Having an LLC does not make you a business, and not having an LLC does not make you not a business. For the people in the back, if you have not created an LLC or incorporated or done anything, but you have started to write off expenses or incur expenses for the purposes of generating revenue, you are a business. So when I talk to people who have received a 1099 or who kind of made a little bit of money on the side, or they're in the process of putting their home on Airbnb or renting out some portion of some asset, you are a business owner and we need to start acting like one. Now, for the people who are like, well, I didn't set up my LLC and I don't have a business bank account, but I have been accepting Cash App payments, Venmo payments, PayPal payments, and I don't know what to do with it. It really wasn't that much money. We already know that the IRS has been on this, they've been on a fix for this income. If you have business accounts in Cash App, PayPal, Venmo, next year, 2023 tax season, you will be receiving a 1099-K for any transactions over $600. So we know that. We know that's coming. Some of you have already started to make adjustments accordingly. Some of you are like, I'll get there when I get there. I'm telling you right now, they about to be in your pockets. So if you've switched to Zelle thinking that you're so nifty, Zelle is not a part of that 1099 track right now. Couple reasons, and this is just theory. One, all business bank accounts do not offer Zelle. So the IRS is not looking at Zelle as a third-party merchant account. They're looking at that as a pass-through account between personal or individuals. However, if you think the IRS is all up in your Cash App, Venmo, and PayPal, and they won't be on Zelle, you are living in a fantasy world. I think that they will be on top of Zelle by 2025. So make sure that right now you're adjusting your prices to write off any additional fees that come from third-party merchant services to pay whatever taxes that you might need on that amount of income, and you are preparing to claim all of your income on your taxes. That actually just skipped to the bottom of my notes, so we gonna start there. Don't eliminate income. Stop it. I'd rather us focus on write-offs, focus on the deductions, focus on what tax code and tax law allows us to do versus say, I'm not going to claim that $500 from over there, or it was only $1,200. I'm not going to claim that, or I'm only going to claim what I received on this 1099 because that's only what the IRS sees. There is some truth. There's some truth and the things that you receive tax forms, any W-2s, 1099s, Schedule K-1s, those are the forms that the IRS already has their hand on. They already have a return in place for you. They already see you as tax code, need to give me $50,000 already. They are just waiting on you to tell them what was deductible expenses, what did you do with that income, who did you pay that should be paying their taxes on that income, and they're sitting back and waiting on you. When you send in your return and it doesn't even match what they have as your gross, it's actually less, that is the number one way to get audited. So stop trying to eliminate income or save on taxes by eliminating income. Let's talk about write-offs. Let's talk about maybe transitioning your business into a different type of entity so that we can write off a lot more of your day-to-day from the business before paying taxes on it. Let's do that instead of saying this income wasn't that much or I'm claiming the majority of my income. Let's claim it all. So if you are in a side hustle business or generating a ton of money, but just not established as an LLC or something like that, and you've really been skating by, don't let that be your business model. Your business model and your business pricing should include whatever type of liability you're going to generate based on the amount of money that you have coming in. Back up to the top. LLC and sole proprietors. Any of those individuals, like I said, again, if this is a side hustle or you have not begun to establish that income all the way as a business just yet, all of that goes on your personal 1040 return. You would just be having a Schedule C, Schedule E for some of my rental businesses. That's it. It goes on your personal taxes. So some people are like, I want to file my personal taxes and my business taxes. It goes all together. And a lot of times tax professionals fail to make sure that their clients understand that. So a lot of y'all clients coming to me because they think that y'all did something wrong. And then I explain to them that their business goes on their personal. So just in case you're a tax professional following me, tell your clients. Those individuals, every single dollar that they do not deduct is earnings. Meaning, if the business made $100,000 and you had $25,000 in write-offs, $75,000 is subject to self-employment tax or employment taxes if you are S Corp, giving yourself a W-2, 15.3%. That's 15.3% in addition to that $75,000 going on top of whatever other income that you have, may it be a W-2 or anything else. Where's your tax bracket? Your tax bracket is well above where it would be if you were in an S Corp and you were writing that stuff off properly. So I'm not going to talk too much about that because I got a million videos talking about the difference between the S Corp and the LLC, and I want you guys to check them out. But we are going to talk about those thresholds. If your net income after you take care of all of those expenses is more than $45,000, stop worrying about, am I ready for an S Corp? Because you're killing yourself with tax liability. And yes, you better get ready for an S Corp. If you're in business and you are saying to yourself, I just don't understand business, or I don't really understand the numbers, or I don't know where to begin with my accounting, you're either not going to be in business that long, you're going to kill yourself on tax liability and be indebted to the IRS forever. So they start looking into your accounts and looking at your other assets to try to take on. Or you are trying to save a couple dollars by not hiring an accountant, not getting a business coach, not talking to me. And it's killing you. I hate when I have my, within the first 5 years of business, people who are generating tax liabilities of $10,000+, when they have been following me forever, when they have been talking to me, have been on at least one business consultation with me, and I've told them about quarterly or estimated taxes, or I've talked to them about switching over to an S Corp. It hurts me, it pains me to send the IRS this $10, $15, $20,000 bill that I know you're not going to take care of this year when April Q1 for 2023 is due. So you still paying on 2022, maybe even 2021, and 2023 is here, and it's time to start paying some estimated taxes. What are you waiting on? Are you waiting on them to impose themselves all up in your business in order to retrieve the money that you are owing, or what? I have to remind you that the IRS compounds interest daily. Every single day they look at your balance and they add a little something on it. This is not a debt that you want to carry. So for some of you are like, it doesn't affect my credit. Okay, true, to an extent, it doesn't. All right, so you're good there. But what if you want to buy a house? They want to see that most recent tax bill paid in full. And then if you are on an installment agreement for prior year taxes, they put that in your debt to income ratio. Again, shooting yourself in the foot. All around, just not maximizing what is due to you. Let's stop it. So, creating a corporation. We talk a lot about S Corps. And I do have some clients that are sole owner C corporations, which I am not typically on board for. C corporations are taxed twice. The corporation has its own taxes, and then you also generate a Schedule K-1 for all of the shareholders, and then that is included in their income, and they pay taxes on that income as well. It is not something that I recommend, especially for sole proprietors who are trying to get the benefits of a corporation. You want to stay in the S Corp. Corporations, however, I always talk about income levels and net revenue or net profit, but we also have to look at your organization. So if tax season still stresses you out every year, especially if you've been with me for multiple years and you still stressed out, knowing you know what I'm about to ask you for, what invoices, what receipts, where is this on the bank statements, make it make sense, help me make it make sense for you, and you still stressed out because you still ain't looked at your accounts, or you just now trying to reconcile your QuickBooks and it just ain't adding up and everything is all out of whack. What we doing? What are we doing? Why are we shooting ourselves in the foot? It is imperative as a corporation for you to make sure that quarterly you are paying your estimated taxes on your total tax liability as well as your employment taxes for you. Now, just to kind of back that up a little bit, as corporations, you're electing to the IRS that you want to be used as a pass-through entity. You're saying, IRS, I know I'm collecting all of this money, but it's not all going in my pocket. Some of it is for reinvestment back into the business. Some of it is to grow my payroll and staff. Some of it is just to make sure that I have a rainy day fund, and I want to keep it that way. But you're also telling the IRS, because I'm the sole owner, you know that I'm working this business. You know that a lot of the earnings and a lot of this revenue, if not all, is being generated by me. Meaning that some earnings taxes are due. If you are the sole owner of an S Corp, you must be giving yourself a W-2 out of that income. That W-2 wage, unless you trying to be honored it, needs to be 30% of the net profit. That's like a general rule of thumb. Yes, different businesses, we could get away with some other things. There's always something we can do. But general rule of thumb, because a lot of you will say, well, how much should I pay myself? I'm giving you, here it is. Here's the tea. You got it for free. Like, Why you still ain't pay yourself out of that business? Now, giving yourself a W-2 wage doesn't necessarily mean that you need a payroll system in order to figure this out. You can still be transferring yourself money out of that account. We can use those transfers quarterly to figure out what your employment taxes are on that amount of money. Now, if you are making $100,000 in your business and you are transferring $90,000 to yourself, this ain't working for you. You're not really taking full advantage of what it means to be an S corp and a pass-through entity. You're still paying earnings taxes on everything. So this might be some redistribution of how you are allotting money within that business. Could the business be taking on some of your dependent care expenses and being a write-off throughout the business instead of out of your personal? Could the business, take on a portion of your life insurance, all of your health insurance, your IRA deduction? All of these things can be coming out of the business. These are all write-offs. These are all things you need to show on your W-2 at the end of the year, but I digress on that. But are you taking advantage of the things that can come out of the business to reduce the amount of money that you need to transfer to yourself? Most of you is no. So you're probably shaking your head as you're watching this. I'm telling you it's a no, and I need it to be a yes. I need us to stop transferring the heck out of all of this money when we could be utilizing our business account to pay it, to deduct it from our taxes, and then get to it. Okay? Then, claiming a loss on your business. This is one, I just got off a call with a really good client, and they mentioned that they didn't even want to take a loss on the business because they felt like they failed. This is the biggest myth of it all, and then I'm going to mic drop this so I can get back to work. Claiming a loss on a business is how Donald Trump is still rich. It's how he didn't pay no taxes. It is how he got away with everything. Claiming a loss on a business did not make him a failure by any means. It does not make you a failure. Claiming a loss on a business can have a huge benefit on your tax return. Claiming a loss on a business for a certain number of years does not automatically make you a hobbyist. But claiming a loss on a business must be strategic. If you made $5,000 and every year you write $10,000 in supplies off, you are a hobbyist. I don't care what you talking about, what you think you planning. Don't get it twisted. Couple things that you might want to look at, and this goes to buying a house too. If you're going to buy a house and you want to make sure that you are decreasing your tax liability, but also keeping your income high enough to get that mortgage, here's a couple things you want to consider. Depreciation. Depreciation is saying, I bought this thing, but I know that in a few years, I will have to buy it again. So it is losing the value of this asset every single year. Losing the value of the asset isn't necessarily taking money out of your account. So mortgage loan people typically will add that depreciation back into your overall amount to give you a higher income. Adding depreciation will lower your tax liability. Your depreciation can be more than what you made in that year. That sounds like a winner to me. I'm just saying. Another thing is business mileage. Business miles, you're not saying that I'm actually spending a ton of money on, gas repairs and maintenance, oil change, all that stuff. You're saying that I had to drive several miles for my company to meet with new clients, to go to separate offices, to, host events, to get new vendors. Whatever the case may be, those mileage, it can be used to be a deduction, but not so much to the IRS. Are you saying that I'm just spending so much money with this business, even though I'm not making any. Continued education, legal and professional, research and development, all of these things you want to be strategic about, make it make sense. Every dollar you deduct, you want to be able to tell the IRS that I did this in order to try to make this money that I either made, got a contract for, or have in limbo. Okay? You're not saying I just spent this because it go with the business. Some of y'all got boutiques on your taxes and it's just because you buy a lot of clothes. Are you planning on reselling them? Are you trying to figure out, what kind of clothing line you want to have? I don't know. Make it make sense. Help me. So if you are just putting on your return a loss on a business just to reduce your tax liability, and you have been doing that forever, be cautious. Be aware that the IRS understands that this is a very small, tricky little loophole that reduces tax liability. They're already looking for you. Be sure that you have some business bank accounts, some receipts, some invoices, some explanation as to why you did X, Y, and Z. Be prepared because they could come at any moment. And you want to make sure that your taxes reflect what you actually did with those expenses and not just, I claimed a loss. Now, if you have not made any income and you have been claiming a loss on this business for forever, let's just table this until we know that we're about to generate some income, and then let's see what we can bring back up to the table, okay? But right now, don't let that be your tax strategy. Your tax strategy should be to reduce your tax liability as low as possible and make sure that you're paying it throughout the year and not just at the end. So, business owners, claim all of your income. You are a business in the eyes of the IRS the moment that you have any additional income on the side. If you are, making cakes or t-shirts on the side, or if you have established the business in full, LLC, DUNS number, all of that good stuff. Or if you just don't even know how you're making all this money and you ain't took care of nothing. In the eyes of the IRS, any income is presumed taxable. So I'm saying start acting like a business right now. All right, guys, I gotta go. I am glad you joined me. I have this on my page. I started YouTube. Go like, comment, subscribe. If you want me to do your taxes, set up a business consultation, take on all of your bookkeeping and accounting services for you, or even coach you and let you know everything that I know strategically so that you can start this business and grow this business, definitely contact me. My booking site is taxteamservices.com/bookappt. All of the links are in my bio. If you're just getting started with business and you're not really prepared to pay my fee for a business consultation, but you just kind of want to pick my brain, I wrote a whole book debunking the myths of fame. Look. For all of the people, who have heard all of these different things about businesses, I debunk those myths and I go through a step-by-step guide to starting a business. So, link in my bio. Definitely get with me. I'll continue to jump on here as often as I can to share some of the things, but it's time, guys. You can't just say to the IRS, I didn't know I had to do that. It is not an excuse that they accept. So let's get on top of it. And don't start an S-Corp too soon, because if you start an S-Corp, didn't make any money, and don't file taxes on it, you still get a $210 per month after March 15th bill. March 15th, S-Corp taxes, partnership tax returns, they are due. C-Corps, you got till April 15th. April 15th, estimated taxes are due for quarter one of 2023. Don't fall behind. I'm telling you right now. Love you guys. Let's definitely connect.